There's a new survey out showing nearly half of all chief financial officers in the U.S. expect a recession to hit our economy by the end of next year, and a whopping 82% believe that a recession will already have begun by the end of 2020. Our next guest says it's actually not all doom and gloom ahead, and he just penned an op-ed letter to President Trump on FoxBusiness.com outlining why. Joining us now, Michael Block. He's Managing Director and Market Strategist at Third Seven Advisors. Michael, what do you think? Is a recession by 2020 likely, as so many of these CFOs think?
Well, I think a lot of these CFOs see what's going on in the market, and it colors their views. And granted, when the market goes down like this, David, it means that there's a better chance. I believe in a wealth effect, and it's hurting confidence. It's hurting asset prices. It's hurting business owners' willingness to invest. But there is a way out. And in this op-ed letter that you cited, I talked about how public policy can help steer the way. Fact is, growth is slowing. But if we get the right kind of tax reform,
I don't know if I got an answer. Is there going to be a recession by 2020?
I still don't think so. I don't think it's. The question was, is it likely? I said no. Is it possible? Of course, it's possible.
Yeah, but likely no.
But I think there's a lot of different ways that that the powers that be can help prevent that. Well, one is helping increase wages and wages via higher productivity. One is by putting money back into the economy via infrastructure spending, and then three is getting this trade deal done with China. That happens. Free markets flow. I think we have a good chance of working our way out of this. People say we're at the end of the business cycle. I say there is no business cycle anymore. It's been manipulated and stretched like saltwater taffy, as I said in my letter to President Trump, the Atlantic City connection there.
Yeah, Michael, it's Kevin. The interesting aspect here is that I don't necessarily disagree with the CFOs by the end of 2020 because a recession is really just a slowing of economic activity. So if we go from 4.5% growth on GDP down to 4%, if the unemployment rate goes from 3.7% to 4%, and you start to have some slowing and reduction in that growth, you could consider that a recession. And the problem with CFOs is that they're the ones that are having to deal with the two largest input costs, and that's labor going up and the cost of capital. So I'm okay with those CFOs, and sure, maybe we get a recession, but it's not going to be like the great financial crisis. My biggest concern is what's happening with the Fed's balance sheet, and that in physics, for every action, there's an equal and opposite reaction. And what they did is they went out there and they loaded up their balance sheet and they suppressed financial volatility. I think financial volatility is going to come back. We've already seen it. Do you think that's the biggest risk to these markets?
Yeah, what I'll say is this. The biggest problem the markets have right now is themselves. We've seen that volatility, Kevin. You and I live it every day. We've seen a lot of that. And again, that's hurting those CFOs' confidence. And look, a lot of things can happen by the end of 2020. You and I could be running a seafood restaurant in Annapolis by then. That just sounds like a good idea.
You need to write your check for a business model.
Yeah, there's a lot of different things that could happen here. But yeah, there's a lot of risks there. I do think that there is a way out of this. And I'm not wanting to end of the cycle, guys. Again, I don't think there is a cycle anymore. I think it's been stretched out. Let's see what happens.
I was going to say, one Fed or two Feds have gotten a soft landing right since like 1960. So even though President Trump has been more vocal than any other president about targeting Jerome Powell and saying essentially, please don't raise rates, he does have a point in that usually in a rising rate environment, you have a 12 to 18-month lag and you do have slowing.
Here's the problem. We have all these economists. We have all these economists talking to those CFOs and giving them advice, and they're tunnel visioned. All they think about is the data, and they think about specific data. They say, oh, the economy must be great. U3 is at 3.7%. There's job growth. Wages are up 3.1%. Well, there's a lot more to it. And there's one thing that we're seeing now, Deirdre, it's that with Jay Powell suddenly sounding more dovish, part of that is slowing data, but part of that is the markets. And I've been saying this over and over again. It's not just data dependence, it's market dependence. And say that however you want to say it, but the markets feed the data, which feeds the markets, and it all feeds.
And he's also talked about the risk of the U.S.-China trade relationship. I mean, and clearly, yes, data dependent, but I hear what you're saying.
Well, no, everyone's like, usually I say market dependence, it's like it's heresy. I'm sorry, Carol.
Yeah, no, I was just going to say, as a recovering investment banker, I spent a lot of time with CFOs in my days. And certainly, as they see the market is not giving them any credit for growth next year, they're in a position they want to underpromise and overdeliver. However, this does sometimes become a self-fulfilling prophecy. And I would say the biggest issue that we're facing is short-termism. The fact that all the CFOs and companies are so focused on delivering the next quarter that they're not making the investments in the plays for the long term.
You know, Carol, what you said, first of all, someday I hope to be a recovering investment banker. Second, what I could say is this. I mean, look at a company like Applied Materials. They're in the middle of this trade war. They're in the middle of everything going on in tech right now. Their guidance was so gloomy, and yet the market digested it. The stock did a lot better. I think there is a lot of sandbagging, Carol. But you're right. If confidence isn't up and everyone starts drinking their own Kool-Aid, pretty soon you're going to have a stomach ache and a sugar buzz and you're going to pass out.
So, Michael, I really like your recipe for how to forestall the recession. I like higher wages. I like infrastructure spending. I just have one problem.
What is it, Rick?
You know what it is? That 3.1 reference you made to wage increases, which is correct as a nominal increase, when you look at the actual increase, we are way behind where we should be in an economy like this. We're
not going to get 10 years to get that.
We're not going to get the infrastructure investment. So in other words, your recipe is great, but we're not going to do it, and that means recession.
Well, it's like anything else. Like you can't, you need to do your prep work, and the prep work might be, instead of just giving tax cuts to companies and letting them buy back stock or make stupid acquisitions and things like that, tie those tax cuts, tie tax reform to companies putting money back into training.
Too late. You're right. Too late.
It's never too late.
That ship has sailed.
Now, and that's why we're seeing some of the slowing growth. Okay, hit the reset button. Let's try this over.
We haven't mentioned politics. We got a Congress that's at loggerheads with the president for the next 2 years. Is that a problem, or maybe that's not a problem? Maybe it's the opposite.
I don't know. Which bipartisan group do you want, David? Do you want the Nancy Pelosi who's making friends with President Trump on Twitter and making gestures about reaching across the aisle, or do you want President Trump telling the President Trump that's telling Chuck Schumer that he'll be proud to own a government shutdown, or do you want Nancy Pelosi talking about skunk tinkle again? Which one are we going to get? It's up to the leadership. You're all watching this. Let's go. Let's see what it was.
We don't want any of that. Just one reference is too much of that.